In today's price action trading episode, we're talking about false breakouts, liquidity grabs, stop hunts, whatever you'd like to call them. We're going to talk about how to trade them and how to use them to your advantage, as well as avoid getting stopped out preemptively. So without further ado, let's jump into it. Welcome back to the channel, you guys. This is, I think it's our fourth episode in our price action course that we're doing here. This is totally free, and if you're enjoying my content, make sure to hit the thumbs up button and subscribe to the YouTube channel for more content like this. Okay, so how many times have you been in a situation where you enter into a trade? Let's say that you get into a long trade, right? You buy this market, and as soon as you get in, it shoots against you just before rallying in your favor, but unfortunately, it hits stop loss for you and you're out of the trade for a loss. If you're saying you've never experienced that, I'm gonna argue you're probably lying, because most of us, I feel like, have experienced that. And so in this video, what I'm gonna do is I'm gonna show you a little bit of how I try to do my best to avoid getting preemptively stopped out of a trade, as well as how to spot liquidity grabs, how to spot stop hunts, whatever you'd like to call them. Really, to me, it's just market structure and understanding what's going on at a level. So let's start with the basic premise. Let's say that you have a situation in which case we have a major level of support, right? And everybody who is anybody in the markets is watching that level of support, and they're saying, okay, this market seems to be rallying off of the lows here, right? So every time price comes down to this area, it finds buyers and we shoot off the bottom. At some point, the market becomes sort of predictable in this way, and there's debate about this on whether how much of this is true or not, but what we do very often see is price will come down to a level, attempt to go underneath, in which case some traders, perhaps the smart money traders, will make the argument that this is a liquidity grab before running higher. There are several ways of calling it. You could call it a 𝗀𝗂𝗯𝗀𝗀𝗰 method is one way of calling it. Some people call it liquidity grabs. Some people call it false breakouts. Some people call it stop hunts. There's a million terminologies for this thing, but at the basic core of what's going on, we are seeing price shoot underneath a major level of support. A lot of people do inevitably get stopped out because this is where stop loss placement ends up being, and then the market rallies back in the other direction. Is this done intentionally? Is it done maliciously by smarter traders, big hedge funds or whatever? To me, that doesn't matter. The point is it happens, and it's something that we can observe as traders, and who cares who's doing what or who the smart money is or whatever. The main point is it's happening, and it's something that we can observe and we can take advantage of. So my first thing I'm going to talk about is I don't actually use that as an entry trigger. So I don't actually use a bust underneath as, oh, I'm going to buy here, because it could genuinely just be a breakout underneath support, in which case I'm not going to try and buy here because, again, it could just be a flush to the downside, and I don't want to be buying into a flush point. So what I mean by flush point is, again, going back to our drawing where we have a major level of support, you might argue, oh yes, it's going to go grab, stops, and then come back up. But sometimes you see a break like this, and then the market just shoots lower. So there's different arguments, but for me, I'm still willing to buy support at support. I don't try and get fancy or cute with it. I really buy levels of support that I want to buy markets in, and I put stops below. But here's where things matter. This is our first major point when talking about stop hunts, liquidity grabs, whatever you want to call them. How do you avoid getting stopped out just before a rally? And here's my response to that. Here's a trade that I am actually in right now. And what you'll see here is that I've got the replay function going. Let me show you something. This is my entry. This is where I'm in the trade, and I'll show you my trade in just a second. My actual figures, my actual account. I am logged into a real broker, so it's no nonsense there. So look at this. My stop loss is here. My entry is here. And if I'm going to press play here and let this thing go again for a little bit, what you can see is that price did not hold my level of support as well as I would have liked. In fact, you could have made the argument that my entry was bad and, shoulda, coulda, woulda entered right down here where your stop loss is, Nick. But here's the thing. When I take a trade, I do consider the idea that it is possible that there could be a little bit of grab here underneath a supportive level. I understand that that is something that occasionally happens, not always, but sometimes. And so when I place my stops, my first consideration is, where am I going to avoid most of the other people's stop losses? And that's where we're at. Notice that price came underneath. It doesn't always do this. Sometimes, my entry is just right and price rallies without going underneath. But sometimes, again, it comes and it tests underneath. So how do we place a stop loss that we know is going to likely still hold even if there's a bit of liquidity grab or stop hunts or whatever? Well, to me, the simple solution is to widen the stop a little bit and to reduce the position size a little bit. So I've taken a smaller size to let this trade play out. And now in this case, I've been able to hold on to this trade. And now if we exit the replay function here, this is my actual trade that I'm in right now. So I've got 56,000 units open long, and you can see that I survived a false breakout. Price tried to go lower, tried to go underneath that supportive level, and sure enough, we actually rallied just after coming underneath. So perhaps if my stop loss was too tight, I would have gotten stopped out preemptively and the market would have gone on without me. Right now, we're doing major discounts on everything inside of our digital store. If you'd like access to our private Discord channel where we share our trades, you can see things that myself, Frank, and the rest of our top traders here at A1 Trading are trading actively. Get notifications to your phone. You can join our trading chat room and see what people are talking about in the chat room. And if you'd like access to our software tools, such as the A1 Edge Finder, which is our market scanner that our team has been developing, you get massive price discounts by using the subscriber discount codes that are down below in the description right now. Punch those codes in, YTVIP at checkout, and you'll get a major subscriber discount. But this is why I do like to keep my stops relatively tight, but not so tight that any little retest underneath the level of support is going to get me out. I like to keep my stops wide enough so that if I'm wrong, I know I'm pretty truly wrong, but not too far so that I'm not risking any extra that I don't need to. So for me, how do you measure that perfectly? Well, there's a couple ways, but here's one suggestion that I would recommend. Take a look at this. Let's look at the average true range for a second. And the average true range is a simple indicator. Again, I know some people don't love, I know this is a price action related course, but I do like to use some simple indicators to get an idea of some simple things. So check this out. At the time of taking my trade, the average pip movement per hour was about 11 pips. And because this is a swing trade, I actually entered on the 4-hour chart. So let's look at the 4-hour bar. On the 4-hour bar, at the time of taking my trade, the average volatility was about 25 pips, let's say. So in this case, what you can see is that my stop loss is 35 pips, give or take. I think it was more like 30. The point is, I left enough room that the average range would still be respected if there was an attempt to go lower. And take a look. Where did our stop loss go? Or where did our trade go? About 25 pips against us. This is within the realm of a normal volatility move. If it had gone 35 pips, I would have gotten stopped out of the trade. You could see 35 pips would have stopped me out of the trade because that would have been an abnormal outside of volatility, the expected volatility move, in which case I would have been stopped out. So that is how I'll use the average true range to get a better read on where stop loss placement could go. And I would recommend you to play around with that, check it out for yourself. But again, that's how I'm going to basically avoid unnecessary stop outs by using this. Now, is this the Holy Grail? No. The next point of reference that I want to talk about is how do you use that concept of staying in trades? How do you, that's the first part, is how do you stay in a trade that you're in? Using normal market structure trading, which is what I tend to do, price action, market structure, etc., by widening the stop just enough, using the average true range, using market structure, etc. But next, let's talk about something else interesting. Let's talk about using false breakouts to your advantage to potentially trade against a concept like this. And let's say in this case that you have a short bias, okay? So you're looking for sells on a particular currency pair. And excuse my terrible handwriting. Let's say that you are looking for sells. Let's say the market is, we'll use white here. Let's say the market is trending down and we have entered into a consolidation phase and you are very willing to take shorts on this market situation. Let's say that you're looking for shorts and you're looking for some sign of failure. And we'll go ahead and mark this area here as this is kind of our, let's say this is just our rough example of a strong level of resistance. Okay, actually what we'll do is we'll just make this, we'll make this red. And let's say that you're looking at this and you're saying, okay, all the retail traders are up in this area. And let's say you're just observing, because at this point you haven't seen any entry triggers, and you see a scenario like this, where price breaks to the upside and comes right back into this range. The interesting component to what we just saw is that if something like this happens, what are the buyers thinking? They're thinking, oh no. Because if price tried to go higher and then failed and collapsed back into this range, That's not good for buyers. In fact, what that tells us is that there's a lot of sell pressure that could be leading us into a bigger sell-off from here. So if you see a false breakout that does not work out, meaning how do we define false breakout? Let's say it breaks structure highs, but then immediately sells back into the range and does not make any sort of substantial gains, like a break and retest, you know, watch out, that's pretty bullish. But if something breaks and then just does not hold the retest at all, that's an early warning sign that we very well could be headed lower, and there could be opportunities to sell into that on any sort of weakness, perhaps even looking to sell the break itself, however you like to enter exactly. But this right here, this little scenario where you get a failed break higher can be a very powerful signal saying that the buyers have been really tricked out of their positions and things could collapse much lower from here. So again, the first thing we talked about today was how to avoid getting stopped out for a stop loss when you have a scenario in which you're placing a position with market structure. The second scenario is actually how to use a break like this and a retest like this. In this case, right? We saw a price did one of these, and that was really strong for the bulls. You could even use that as a potential bullish indication that we are probably headed higher, right? So using all these things together, we can combine false breakouts or liquidity grabs, whatever you would like to call them, basically breaks underneath market structure and strong demand or strong supply in reaction to that. When we see that, that's a clue from a technical analysis standpoint that could be pretty powerful. If this video was helpful to you, hit the thumbs up button, subscribe for more, and we've got more videos for you, so check them out right here. Looks like it's time for your next trading video. Check out the videos here and here for more free trading content that should help you in your trading journey. We try and keep it real here, so make sure to subscribe for more content that is down to earth, realistic Forex trading content. See you in the next video.